Hello, students. Welcome to this session. I'm your professor, I'm your instructor, Ms. Natalia Francois, and today's topic, Principles of Finance. We're going to look at cash flow and cash planning. It's topic number 4 in your course schedule. Now, today, our learning objectives would be to understand tax depreciation procedures and the effects of depreciation on the firm's cash flow. We're going to discuss the firm's statement of cash flows, operating cash flow, and free cash flow. We're going to understand the financial planning process, including long-term strategic and financial plans and short-term operating financial plans. Now we're going to discuss the cash planning process and the preparation, evaluation, and use of cash budgets. Then we're going to explain the simplified procedures used to prepare and evaluate the pro forma income statement and the pro forma balance sheet. Then we're going to evaluate the simplified approaches to pro forma financial statements, preparation, and the common use of pro forma statements. So let's get started. Depreciation. Depreciation is an expense of a fixed asset. And we would have learned in accounting 1 and 2, when a firm buys an asset, it's depreciated over the life. It no longer has a value after a certain number of years. This occurs over the lifetime of the fixed asset. What depreciation does, it reduces the income that a firm reports on its income statement and therefore reduce the taxes that the firm must pay. So think about it. Remember your income statement. If I refer to your income statement, it's usually your revenue less your expenses to give you profits. Now, if depreciation falls within an expense, what will happen? It increases our expense and thus reduces our profit. Now, tax, so this is net profit before tax. So what happens when you pay tax? You're paying a percentage of this. So if this is lower, you pay less taxes, right? So this is how depreciation helps a firm pay less taxes. This reduces its income before tax. Its deductions are not associated with any cash outlay. So we know it's not physical cash is being transferred. It's just this is when the firm deducts depreciation expenses, right? It is allocating a portion of the asset's original cost that the firm has already paid for as a charge against the year's income. The net effect in that depreciation deduction increases a firm's profit because it reduces a firm's tax bill. The following items are important in determining and recording depreciation, right? We're looking at cash flow planning and financial planning. So we're looking at depreciation. It's not a cash item, but how do it affect our income? So it's covered in this section. So in depreciation, there's a book value. The book value is the asset's original cost less accumulated depreciation. So after 3 years, depreciation would have accumulated for 3 years, right? So the book value wouldn't be the original cost, it would be the cost less depreciation accumulated. Useful life will be the length of time the asset will be productively used within the operations. Salvage or residual value will be the price the asset will sell for or be worth at a trade-in, when its useful life expires. Often the salvage value is estimated based on past experiences with similar assets. Then you have the depreciable base cost, the depreciation expense over the asset's useful life. So for example, if we paid 50,000 for an asset and we anticipated the salvage value, this is how much we're going to pay for it, how much you're going to get for it after, the depreciation base is 40,000. We expect 40,000 depreciation, so this will be an expense in our income statement, over the time period in which the asset was used and then be sold for $10,000. Depreciation records an expense for the value of an asset consumed and removes that portion of the asset from the balance sheet. So every year the balance sheet, if you paid $50,000 for it, every year the balance sheet won't be $50,000 asset. With less depreciation, less accumulated second year, less accumulated third year, and so forth until it's no longer part of the balance sheet. Now, there are three methods of depreciating. You have the straight line method. This method is depreciation that evenly splits the depreciable amount across the useful life of the asset. And we're going to go through them in examples. The unit of production depreciation method. This base depreciation on the actual usage of the asset, which is more appropriate when an asset's life is a function of a usage instead of time. So straight line is over the life in years. Units is over its production capacity. So this might be a printing equipment or maybe equipment that makes bottles, plastic bags, or something like that. The double declining balance depreciation method is the most complex of the three because it accounts for both time and usage and takes more expense in the first few years of the asset's life. Double declining considers time by determining the percentage of depreciation expense that will exist under the straight line depreciation. So I have an example. When we're doing the straight line, the calculation is cost, right? Cost of the asset minus the salvage value, meaning how much it could be sold for at the end of the useful life, divided by the useful life. And with straight line, remember we said it's over a time. So the useful life we are using. So let's look at this asset. This asset, let's call it a printing equipment. Was purchased for $58,000. So this is the cost, $58,000. The salvage value is $10,000. Under the straight line method, all right, the useful life is 5 years. Right? So under the straight line method, we are told that it's split over the lifetime of the asset. So the formula is cost minus salvage value divided by useful life. So the cost here is $58,000 minus the salvage value of $10,000 gives us $48,000. We divided that by the useful life of 5 years, give us $9,600. So over year, for the first year, year 1, depreciation will be $9,600, right through year 5, $9,600 until the total depreciated value of the asset is no longer with us. Now, the unit of production method. Now, I said before, this method uses the usage of the assets, not just the time, the usage. So in this case, the usage of this asset is 960,000 units. So let's say the printing equipment, let's say this is paper, right? They can print 960,000 papers, right? So in the first year, the company would have recorded 180 units produced, right? Out of that 180,000, how do we find the depreciation value? Cost is 58, right? 58,000 minus 48. usage value, salvage value is 10,000. 10,000. So we have here 48,000. Now we need to multiply this by the units produced, 180,000. Right? 180,000 divided by the estimated units, total units to be produced. We were not given, in this situation, we were not given the estimated, we are given the units produced. So how do we find what's the cost per unit? What's the depreciation cost per unit? Depreciation cost per unit would be the 960,000 units. So let me erase this. Right? We weren't given all this information. So the other way we do it, we find the depreciation cost per unit. So we have 960. This is the lifetime. This is how much units can be produced out of this equipment, right? And we know the book value is 48,000, right? The 50,000 minus 10,000. So 960 divided by 48,000, we get, that's what? 5 cents, 0.05. So the depreciation cost per unit is 0.05, right? So if we have 180,000 units being produced, how much is the depreciation expense? 180 multiplied by 0.05 give us 9,000. Year 2, 200 units was produced. 0.5 or 5 cents per unit is the depreciation expense, and so forth until the depreciated value comes back down to the book value. And if you check the units, you will realize it is 960. So the equipment have used up its lifetime, right? Then we have the double declining balance. In this simple form is basically the book value. The book value for the first year would be 58,000, right? So it's 58,000 for the first year multiplied by the straight line depreciation percentage. If we use the percentage here, we say 96 divided by 48. The percentage is 20%. So we use the percentage here, 20% times 2. We're doubling it. And we're going to get this figure. Now the book value for year 2 wouldn't be 58. It will be 58,000 minus 58,000 minus 23,200. So we're minusing the 23,200. We're going to get 34,800, and we multiply by 20, multiply by 2, and so forth for year 3. Right? We minus the accumulated depreciation, right, and so forth until we come down to 0. Right? It's depreciated over the life. It's depreciated over 4 years actually. So if you look at it, you'd see the highest amount or the most cost is depreciated at the beginning as opposed to year 2 and 3 and 4. So that's how depreciation affects your income, right? It reduces your income balance, and so you pay less taxes. Now, in developing the statement of cash flows, the cash flows is one of the financial statements that is reported in the annual accounts. Now, the statement of cash flow allows financial manager and other interested parties to analyze the firm's cash flow, especially if you want to make an investment, The manager, so we're going to go through this and see how do we analyze these cash flow statements that we see presented. Sometimes they're in the newspaper. How do we know if this is a good investment, a company to invest in? How are their cash flows, Sometimes they report lots of profits. You hear this company report this profit and this profit, but profit is different from cash. So how much cash do they have? How do we evaluate this? The manager should pay special attention to both the major categories of the cash flow to the individual and to the individual items of cash inflow and outflow to assess whether any developments have occurred that are contrary to the company's financial policies. In addition, the statement can be used to evaluate progress towards projected goals or isolate inefficiencies. So we have an example here of a cash flow statement for Baker Corporation. The cash flow statement has three activities that we pay attention to. It is made up of operating activities, investment activities, and financing activities. Now, these operating would be really those things that they do to produce goods and services, what they sell, that brings in cash. Cash comes in from purchase and sale of assets, right? Cash can also come in from debts, loans, or equity, stocks, right? Those things that affect those items are part of cash flow. Now, you see some of the things that add to your cash flow operating activities. Cash flow statement usually starts with your net profit that comes from your income statement. Right? So we know that profit and cash is not the same. So how is it? It starts with the income statement. But we have depreciation. We said depreciation is not cash outlay, it's not physical cash outlay. So it's usually added back to that figure, right? Decrease in accounts receivables, decrease in inventories, increase in accounts payable, accruals, all these things affect your flow of cash because they relate to your operating activities. When these things are added back, you get the net cash flow, the real cash flow from operating activities, which is $780,000, and it's more than the net profit. Same thing with investments. If there's a sale of an asset, is there an increase or a decrease in our cash? Does it affect our cash? If it goes up or down, that will affect your cash, but that doesn't appear in your income statement, so it won't be part of your profit. Financing activities. When the company pays dividends, it's not recorded in the income statement. When the company receives capital or equity or stock, it's not affected in the income statement, so it affects our cash. So these things are added or subtracted based on the increase or decrease that would affect our cash. In the end, we would know when we add all those activities together, we come up with net increase in cash and marketable securities. So this is how much cash your business would have, and this is the cash figure you usually see in your balance sheet. Now, when developing the cash flow statement, right, so I just explained them. Operating cash flows and outflows, they directly relate to the sale and production of the firm's products and services. Investment flows are cash flow associated with the purchase and sale of both fixed assets and equity investments in other firms. Clearly, purchases transactions would result in cash outflows, whereas sale transactions of those assets would generate cash inflows. And the financing flows results from debt and equity transactions. Now, there's this term called free cash flow. This term or this area you want to pay attention to because this represents extra cash a business has after covering its major obligations. A lot of business, they suffer, they don't do well because they don't manage their cash very well. And how do someone determine what is this free cash flow? How do I know that I have, extra cash? How do I know I have extra cash? in my business, and I have more than enough, I should say, to cover my obligations. This is our formula. Cash from operating activities minus capital expenditure minus change in working capital. Now let's look at each component of this formula. So the net operating cash flow, right? So if we don't have a cash flow statement, we use our income statement, and this is how we get our operating cash flow. All right, we call it earnings before interest and tax. If you remember that, this turn EBT, interest, earnings before interest and taxes, right? Multiply by 1 minus the tax rate, and we add back depreciation, because these are items that are not cash related, so it affects our net income. So if you go back to the cash flow statement, you'd realize all these things are added back, right? Because it affects your cash. So when we looking at the baker's example, we have earnings before interest and taxes, EBT, right? 370 multiplied by 1 minus tax rate is 40%, adding back depreciation. Depreciation expense is $100. So the free cash flow of the business, not the free cash flow, the first part of the formula, our net operating cash is 322,000. But do we have enough? Is this enough? More than enough? Let's look at the other components. Capital expenditure. Capital expenditure equal changes in fixed assets plus depreciation. Now, how do we determine changes in fixed assets? We look at the balance sheet because it gives us balance sheet of the company because it gives us the fixed assets. We look at it over the 2 years. So between these 2 years, total fixed assets or net fixed assets, 2012 was 1,200 and 2011 was 1,000. The change that occurred there is a difference of 200, right? A positive 200. Plus depreciation. Now, what is depreciation? We have here accumulated depreciation, right? If we go back to the income statement, we know our depreciation is $100, right? But we can also see it here because the year before it was 1,200, the accumulated one is 1,300. So we know depreciation should be 100. So capital expenditure now is 300. So we have come to the third part. So let's just review. We have cash from operating activities. We've calculated that, right? We have capital expenditure, right? So it just means how much the firm needs to cater for, right? For its capital expenditure. And changes in working capital. Now, working capital is the difference between its current assets and its current liabilities. And now these are the short-term obligations. So what is this working capital amount? In the balance sheet, we have a total of current assets totaling $2,000, 2012, 2011, 19. So the change is a positive $100. What about changes in liabilities? Current liabilities, total current liabilities, $1,400. The year before, $1,400, so there's no change. So our working capital is 100. Now let's put the formula together. Free cash flow, the extra income that we have after covering our major obligations would be cash flow from operating activities, 322,000 minus 300,000 minus 100,000, which is the working capital. Give us a negative figure of 78,000. Now, what does this mean? This means that the firm did not generate adequate cash flow to cover all of its operating costs and investments and investments. and had no free cash flow available to pay investors. Now, if you are part of this company, you had some micro investment in this company, this would be of a concern to you, right? To know what's the cash flow of this firm if you really need your investment amount or you're looking for some kind of return. Or even if you're the manager, right? Some of you are in management. What is the position of your company? If it doesn't have cash, then you may have challenge in doing other things. Now, the financial planning process is our roadmap for guiding, coordinating, and controlling the firm's actions to achieve its objectives. Many of you want to be business owners, and even in your personal life, financial planning should be a part of your life. It gives you a map, it gives you a navigation, a direction, so that you can achieve your goals, right? So as they're saying here, it's guiding you. It's giving you the coordinates: east, west, north, south, turn left, right, right? And giving you the options of changes that you can make so that you can eventually reach your financial goals. So two aspects of financial planning processes are cash planning. So we know cash and profit planning. And we also said, and we also looked at the difference, right, in the cash flow statement and the income statement, that they are different. But when we're planning for it, how do we do it? Cash planning involves preparation of a cash budget. Profit planning involves preparation of pro forma statements. So take note of that. So cash planning involves the cash budget. Profit planning involves pro forma statements. Now, it's important to know, when we're planning, we have a long-term and short-term goals. We set them. Long-term goals would be those anticipated actions or things they want to achieve within 2 to 10 years, financial goals. Short-term is shorter, 0 to 2 years. Bringing in some personal financial planning here to help you along. When you're planning your personal finances, right? You're in college and eventually you will leave college, and from all now you can start planning your financial future. And you list them in terms of, you list your goals, and then you put them in terms of priorities. You look at the time frame before you can get them and the cost. So the priority would help you in placing them in your budget, knowing, what if it should be in the budget this month, this year, right? Or if it can extend, how much you should put. The time frame again also guide you in estimating the span or telling you the span. So here your goals need to be very, if you learn it, your goals need to be very smart, right? They have to be very, very, very realistic. A lot of people don't make their goals realistic, right? And they have to know the cost. You have to know what's the cost of your goals. So in your financial planning, in this situation, this is a student of mine. I pulled it down from a previous class. And the goals set here are to pay off credit card debt, to purchase a computer, set up a retirement fund, start a marriage fund, and create a down payment for a house. Now, her priorities, first on the list is a marriage fund. So maybe she's having a COVID wedding 1 year, or maybe she had a COVID wedding 1 year from then, and the cost of that wedding or that fund is $25,000. So maybe not be the cost of the wedding, but maybe the amount that she needs to put aside for that wedding was $25,000. Her second priority was to pay off that credit card debt of $25,000, because I guess she wants to purchase a home, which is her third priority. So she's getting rid of that debt to save $80,000. That's a down payment for her home, I guess, after marriage. And her fourth priority is her retirement fund, right? Because she knows she has 20 years before retirement. And purchase a new computer. That's fifth on her priority list. I guess she knows, technology will be changing, and maybe in the next 5 years, she would need a computer. So she's planning ahead. So these are her goals, and you see the time frames and the specific costs to it. Now, these will be set in your budget. So we're going to show you how we prepare that cash budget, right? Your personal financial goals should be clear. You should set your personal financial goals carefully and realistically. Each goal should be clearly defined and have a priority, time frame, and cost estimate. Now, pause this video and take some time and think about your goals, right? What you want to achieve in the next. Put it on 20 years, the next 20 years, right? And try to prioritize them. And later on, maybe you can look at finding the cost and having your goals presented in front of you to start your financial plan. Now, cash planning, or we do cash budgets. Cash budgets is a statement of a firm's planned inflow and outflow of a cash. So don't get confused when you hear cash budget. It's basically budgets, but we show you how you do it properly, right? It is used by the firm to estimate its short-term cash requirements, with particular attention being paid to planning for surplus cash and for cash shortages. Now, if you plan to be in business or you plan to manage a business, this is an important skill, right, that you can have that will be an advantage for you as a business owner. Then, cash budgets help you do sales forecast, which is the prediction of the firm's sales over a given period based on external or internal data used as the key inputs in the short-term financial planning process. So we really want to know, would we have next 3 months enough cash? Would we have more cash than we need? Or would we have a shortage? If we know that, think about it. If you know that as a business owner, you're able to build a plan around it. So you know you won't have enough money to pay your workers next 3 months. So you should be seeking a loan, or maybe you should be increasing your products. There are several things that you can do to make sure you finance that cash requirements next 3 months. What about if you can forecast next 3 months you'd have more cash? Then maybe you'd be able to use that for some kind of expenditure or some investments. So let's prepare the cash flow. Cash budget. We start with cash receipts. Cash receipts includes all the firm's inflow of cash during a given financial period. Now, if you're doing a personal financial cash budget, a personal budget, it usually starts with your income, your salary, or if you're getting money, right? So the same thing is that with cash receipts. So it's not sales as we do in the income statement, where we just continue all the sales, whether we get money for it or not, but we are only using those cash receipts. The most common components of cash receipts are cash sales, collections of accounts receivables, so collections of the cash, and any other cash receipts. Now, cash disbursements will be expenses, right? These will be expenses. Cash receipts are our sales or revenue. All the outlays of cash by the firm during a given financial period. So we know depreciation is not a cash expense. So this would not be in our cash disbursement. We're not planning for depreciation, right? We're dealing with cash. We want to know exactly if you would have enough cash or if you would have a shortage. Some of these disbursements or expenses are cash purchases, fixed cash outlays, right, expenses, payments of accounts payable, interest payments on loans, rent, cash dividends paid, wages and salaries, principal payments on loans, tax payments, repurchases or retirement of stocks. Right, so this is cash outgoing. This is how the budget would look like. Right, so our cash budget starts with our receipts, less cash disbursements, net cash flow, add beginning cash, give us our ending cash, less minimum cash balance. Then we'll know if we have enough, if we have excess cash, or we have a shortage. But let's look at each category. Let's do an example. First, we need to find those cash receipts. So we create a schedule, or we create a schedule to calculate exactly how much cash we will have each month. Right? So your budget goes by the month. You can do a 6 months or 3 months, a whole year budget if you can estimate. So it says, Colson Industries, a defense contractor, is developing a cash budget for October, November, and December, 3 months. Colson's sales in August and September were 100,000 and 200,000 respectively. So the schedule, it just starts with the sales forecast. So just to tell us, first to estimate, first to know, let's put any figures down. August, September, October, November, December. So it tells us September, we have 100,000. August, 100,000. September, 200,000. So we have that in. Sales of 400, 300, and 200,000 have been forecast for October, November, December. So we write that down. 400 October, 300 November, 200 December. Historically, 20%, so it's based on data, of the firm's sales have been for cash. So they're saying 20% of the sales, so 20% of 40, 300, 200, we know are for cash. So let's calculate our cash sales. As the first receipt we're going to get, cash sales, 20%, 20% of August, September, October, November sales. So 20% of 100 is 200, 200. 100,000 is 20,000. 20%, so here you see the 20% of 200 is 40, 20% of 400 is 80, 20% of 300 is 60, 20% of 200 is 1, which is 40. Got it? So we've dealt with that. 50% have generated accounts receivables after 1 month. So historically, it shows that 50% of the sales, so we cater for 20 is cash. We have an outstanding of 80. 50% of that 80, they receive it 1 month after. So here we go, 50% again of, well, let's start with October because we're really dealing with 3 budgets. 50% of October, well, September, because it's 1 month delay, so they have lagged. So 1 month delay. So 1 month from July, we weren't given that. So 1 month from August. So it's 50% of 100. 100 is 50. The lag here. 50% of 200 is 100. 50% of 400 is 200. 50% of 300 is 150. All right. So preparing the budget, remember they said they're receiving the cash, so they receive cash. Let's look at November, 60, which is 20% cash, and then they receive 50% of last month, October, cash. The remaining 30% have generated accounts receivable 2 months after. So the cash from August, 20% was paid in cash, 50% was paid 1 month after, and 2 months after, 30%, right? So we have the 30%. So 30% of 100 gives you 30. September, 30% is paid 2 months after, October, November. So 30% of 200 is paid in November. And then for October, 30% of 400 is paid in December. Right. Bad debt expenses uncollectible has been negligible. Alright, so there's no cash on these transactions. So now you see this in your exam or papers. That doesn't relate to cash, it's just to confuse you. Bad debt expense is not a cash expense. So it would not be in our cash receipts or budgets. In December, the firm will receive 30,000 dividends from stock in its subsidiary. Alright, so this is a cash receipt. They're receiving some money. in December. When we add each one, well, we're doing October, November, December, well, we really focus on those 3 months. We see our total cash receipts for each month. Now, this is the first part. We need to calculate the expenses or the disbursements. So let's see what they have. Carlson Industries has gathered the following data needed for preparation of the cash disbursement schedule for October, November, December. Purchases. All right, so we know purchases is an expense. It affects our cash. What happening with the purchases? The firm purchases represent 70% of sales. So how much is the purchases? Let's go back to the sales figure. Sales was 400, 300, and 200. Right? So 70% of 400, 300, and 200. So we've estimated our purchases figure, right? Of this amount, we want to calculate cash. So the purchases is just placed there for us for easy access, right? There's a line drawn. Now we're looking at the cash items, cash expenses. 10% of our purchases is paid with cash. So 10% of 280 is 28, 10% of 210 is 21, 10% of 140. Here we go again. 70% is paid in the month immediately following the purchase, 1 month after. So 1 month after, how much are we collecting? Lag 1 month. So for October, are we paying any money? Yes, we need to pay 1 month, 70% from September. 70% from October will be paid in November. 70% from November will be paid in December. Also, the remaining 20% is paid the month following the month of purchase, 2 months following the month of purchase. So the lag of 2 months, 20% is paid. So in August, that 20% will be paid in October. September, 2 months later, in November. October, 2 months later, in December. So we got through that. Rent payments, 5,000 will be paid each month. 5,000, 5,000, 5,000 rent. Wages and salaries. Fixed salaries for the year is 96 or $8,000 a month. In addition, wages are estimated to be 10% of sales. So we know we have 8,000 every month. All right. Now we need to calculate the salaries. Not the salaries. Salaries is 8,000. We need to calculate the wages, which is 10%. 10% of the sales is 400,000. We said is 40. So 40 plus 8, 48. 10% of 300 is 30. So we have 38. 10% of 200 is 20 plus 8. We have 28. Tax payments. Taxes are 25,000 will be paid in December. We account for it in December. Fixed assets outlay, new machinery costing 130,000 will be purchased and paid for in November. Right. Interest payments of 10,000 is due in December. Cash dividend payments, cash dividend of 20,000 will be paid in October. Principal payments on loan, 20,000 will be due in December. Repurchase or retirement of stock. No repurchase retirement of stock is expected between October or December. Now this is not cash related, so it doesn't affect our disbursement total, right? It doesn't affect our cash planning. So we can see we got now our cash disbursement for October, November, December. right, by totaling it. Now let's see how our cash budget would look like. So for the firm to determine its cash requirements, this is what it needs to do. Subtract its cash receipts from its cash disbursements. That's the first step. Well, not the first step, after we found cash receipts. So we have our cash receipts and we have our cash disbursements. So the first thing we need to do in our cash budget is find the net cash flow. We can see for October, the net cash flow is negative because cash disbursement is more than receipts. And the same thing applies for November. But in December, the net cash flow is more, right? The expenses is less. Then, step 2, we need to add beginning cash. You know, this cash is the cash figure you'd find in your balance sheet. This is the cash figure that you have in your account. So if you're doing your small business and you have cash in your account, this is your beginning cash for the month. So in the month of October, the firm had 50,000, right? So what is the ending cash flow at the end of October? After they got cash receipts, cash disbursements, it's a negative. So they had to use up some of the beginning cash. The ending cash now will be 47. I hope you're getting this, right? So they had a negative, but they used up some of their beginning cash, right, to fund the outstanding. So they now have 47,000 at the end of October. The ending cash now becomes the beginning cash for the next month. So this is why the arrows are here, right? It becomes your beginning cash for the next month. So here we go again. In November, there was an outlay of 98, cash outlay of 98, well, a deficit of 98,000. All right. However, the firm had a cash beginning of 47. So the ending cash is negative 51, right? The fourth phase now, they gave us here now. So after we add beginning cash to the firm's net cash flow to determine the ending cash for the period, finally we subtract the desired minimum cash. So normally there's a minimum balance that you should have in your account, or the firm plans to have in the account. Sometimes it's being used as for like an emergency. No. So finally, when we subtract the desired minimum cash, that cash balance that we normally have, or we should have in our account, maybe just for emergencies, or a requirement by the bank or whatever. When we subtract that minimum cash, right, we get what we will recall if we have excess, or if we have money, if we need money, if we require money. So in October, after we've subtracted our beginning cash, we end up with 47. Subtract our minimum balance. The minimum balance in this case is 25,000. So we have excess cash of 22,000. Now the firm can take this, right? And you can keep it for the period where you have shortage, or they could invest it, right? So let's look at it for November. November gave us a net cash flow. After we deduct expenses from receipts, we get a net cash flow of 98. Our beginning cash at the beginning of November was 47. However, 47 from 98, or 98 from 47, gives us negative 51. And the requirement is 25,000. So we really need, even though this is negative, but we still require to have 51,000, right? Plus we need 51,000. and we were required to have 24,000. So we really need 76,000 in our bank account, right? This is normally noted note payable. So we either take a loan or we use some of this money and finance it, right? So the firm knows from planning that from November, they need to find money. So they may be in September or when they're planning, or August when they're planning for this time, and they're able to see that, hey, in November we will have a shortfall. We would need $76,000 to meet all our cash requirements. Let's look at December. So December, cash receipts minus cash disbursements is 35,000. However, there was a negative 51 terms of cash, right, in the bank account, negative. So the ending cash at December is 16, right? 51 from 35 is negative 16. We're still in the red. And they also need a cash requirement of 25,000. So when you add them, they really need 41,000. So come December, you need to have a cash requirement, plus you need 16,000 to fund your activities. Right, I hope this is not confusing to you. You would get an example to practice on your own. Let's look at it on a personal level. So let's look at it as your take-home pay income. It's $4,775. You're planning for next year, January, February, March. In March, you're going to get some investment income. So that tells you, right, there should be a note, click, click. You should have some investment income. So I would say normally I will get credit union shares within March, right? That's some investment income that's coming in there. So at the end of the month, your income is $775. January, February, however, March, it's more. You cater for all the income. So this is equivalent to cash receipts. Expenses. Whatever your expenses are, in this case, it total $4,026,000. So in January, in planning, in January, you would see that this person would have a cash surplus. A cash surplus of $749. They can take this money and they invest it or they keep it, right? They keep it, they invest it. Come February now, the expenses is more than January, which most times the expenses don't remain the same. It's more than January, right? In planning, maybe it's some insurance for your car or something like that came in. So it's more than January and it's more than your February's income. So you are required to have a cash, you have a deficit. So your expenses is more than your income. You need $516 to finance your activities, to finance your expenses. Where are you going to get that 516? You take it from January, right? You take it from January money. And so now you only have 233. This is the amount of money you have, let's say, in your bank account. Come March, your expenses now total more than your income by 2,531. In this case, you're required to have this money to finance your expenses. Why don't you take 233 from there? You're just required to find 2,298. So how do you find this money? You can either what? Take a loan, right? Short term, what they call a short term requirement to meet your expenses. Whatever your expenses there, you can decide to reduce your expenses or maybe extend it to a later date, right, to reduce this. Or you can work on this income. You can find ways to increase your income. So the same thing applies for a business. You do this cash flow planning so you can determine your cash requirements for each month and plan ahead. Hope you get the concept. Now, we said in cash planning or in financial planning, you have cash and you have profits. So we know they are different. So we've determined using the cash budget how we plan for our cash, or when we want to determine how much profit the business will receive. So profit planning relies on accrual concepts, right, to project the firm's profits and overall financial position. So the accrual now, it doesn't take into consideration. It's different from the cash. We know cash is as cash outlay, cash flow went by. But in profit planning now, we're considering all the expenses, whether we paid it or we didn't pay it, all the income coming in, whether we did get it or we didn't get it. We're getting for everything. So shareholders, creditors, and the firm's management pay close attention to the performance statements, which are projected income statements and projected balance sheets. So we call them pro forma. They are income statement and balance sheets, but they are projected, right? So they haven't occurred yet. We're just projecting them based on the past income statements that we have. What we need for this, we need the financial statements from the preceding year, the years before, and we need a sales forecast for the coming year. And the sales forecast can be given to us by, if you're in marketing, those people in marketing, you tend to determine how much sales, how much products you plan to create and sell or market. You look at your market and you know how much will be available to us. Now we're looking at this company, Vector Manufacturing. This is their income statement, their balance sheet. We're given their income statement preceding year, balance sheet preceding year, and a sales forecast. Sales forecast tells us the units, number of units, cost per unit, and how much will be produced, right, in the following year. So we have our documents. We're doing profit planning. We're going to create the pro forma income statement. So this is the pro forma we're looking ahead, right? There's two methods, the percentage of sales method. And in this method, expenses are calculated as a percentage of sales. So how do we estimate what will be our operating expenses, our interest expenses? How do we determine that for the following year? We use the percentage of sales, and it simply says the item we're trying to estimate divided by sales, multiply by 100. So we want to estimate, we have our sales. We know sales is 100,000 from the preceding year. So we're estimating 2013 sales would be 80%. Cost of goods sold, we use the cost of goods sold figure divided by sales, multiplied by 100. We estimated our operating profit, operating expense, 10,000 divided by 100,000 sales, 10%. We estimated interest based on past. Interest expense was 1,000, so most likely it will be 1%, right? This is based on the percentage of sales and it's estimated. So let's look at this example. After given 2012 income statement, balance sheet, and forecast, we are preparing the pro forma income statements to estimate our profits. So we have sales 135, right, because we're given the forecast. We're estimating our cost of goods sold, which we know was 80%. So 80% of 135 give us our cost of goods sold, minus cost of goods sold give us gross profit, less operating expense. We're estimating that again. This is 10% of 35. Interest expense, 1% of 35, give us 1350. Now where did I get 1%, 10%, 80%? We go back. Previous year it was 80% of sales. Previous year it was 10% of sales, operating expense. Previous year it was 1% of sales. So we are forecasting this year it will be the same, right? And it gives us our net profit, 6,327. Now there's a variable and fixed methods, because not all our expenses, if you see, not all our expenses may be variable. Some of them are fixed, right? You have fixed costs, they are fixed costs. So this is a mixed method where you can do variable and fixed. So you're given in this situation the fixed amount and the variable cost, a percentage of sales. So fixed is fixed, and so like cost of goods sold, it's broken down into fixed and variable. So fixed is fixed. Variable is will be 40% of sales. So we say in 2012 it was 40% of 100,000. In 2013 it's the same 40%, but of the estimated sales figure of 135. Operating expenses, we're given fixed operating 0.5, so it's 0.5% of 100,000, 0.5% of 135. And taxes will be the same, is 15%. Sorry, not taxes, interest. Interest is fixed. Okay, interest is fixed. It wasn't variable. Taxes, however, is variable. So it's 15% of the net profit before tax. Right, to get our net profit after tax. So you have the fixed method and you have the variable and fixed method, or mixed. Oh, then we have the judgmental approach. Now this is used in our balance sheet, and this main purpose of doing this is to find out that required figure we need, profit, that figure we need to finance, finance our activities, whether we should take a loan, what's the money we need in the year, within the year, to cover our business, to make sure it's profitable, right? Not look down the road a year after and say, we didn't make a profit. With this cash planning and this financial planning, you can tell, right? You can tell your organization, you can tell your own business, or maybe you're doing a business for somebody, you're managing a business for somebody, you're able to tell them, based on your judgmental approach, how much they need, right, to make a profit or require financing for their business activities. Now let's look at it. Stick with me. So we are given the information, right, based on judgment. A minimum cash balance of 6,000 is desired. Maybe this is what you need for emergency, right? 6,000. So we're preparing a pro forma balance sheet. Marketable securities will remain unchanged. We know what we're dealing with current assets. So marketable securities is 4,000. Accounts receivables on average represents 45 days of sales, which is about 1/8 of the year. Because Vector's annual sales is projected 135, as we saw in the previous page, receivables will be 1/8. Right, of 45 days of sales, 1/8 of 135, we get 16,875. So that's our receivables. The ending inventory should remain at a level of 16,000. So we're given our inventory level. We don't need to calculate that, right? This was from our previous balance sheet. 25% is 4,000 and is raw materials, and the remaining is finished goods. It makes up the 60. A machinery costing 20,000 will be purchased. So machinery will be purchased. Total depreciation for the year is 8,000. Adding the 20,000 acquisition to the existing net fixed asset of 51,000 and subtracting depreciation of 8,000 yields the net fixed asset of 63,000. Right? 63,000. So when we add current assets, add fixed assets, our total assets is 105,875. Purchases will represent approximately 30% of annual sales, which in this case is approximately 40,500, right? Which is 30% of sales, 135 we given on the previous page, 40,500. That's our purchases. However, the firm estimates that it can take 73 days on average to satisfy its accounts payable. So this accounts payable should be equal to 1/5, which is 73 days of 365 of the firm's purchases. So 1/5 of 40,500, which is the purchases, is 8,001 will be accounts payable. Taxes payable equal 1/4 of the current year tax liability, which equals $455. Right? So 1/4 of tax liability. Right. Notes payable remain unchanged. No change in current liabilities. Now these figures I have here, they are from the previous statements. Please take note. Remember, we're using the previous statements and we're using the projected sales. The firm's long-term debt and its common stock will remain unchanged at 18,000 and 30,000. Right? That remain. Retained earnings will increase from the beginning level 23,000 from the balance sheet 2012 to 29,327. The increase of 632 represents the amount of retained earnings calculated at the end of 2013 from the income statement. So the retained earnings, let me just go back for your benefit. The retained earnings from 2012 balance sheet was 23,000. When we did the projected income statement, we got a retained earnings or a net income of 6,323, which should be added to the retained earnings we have from 2012. So we're estimating at the end of 2013, retained earnings will be where am I? 29,000. 23 plus 6,327 will give us. However, when we total our balance sheet, it's 97,582. It doesn't balance. It's off. It's off by 105,875. This difference here is what is required. Total financing. This difference, oh my God, sorry. The difference is 8293 to balance it, to make it equal. So this here, this external required financing, this is what we would need, right, for our balance sheet to balance. This is what we need, some external financing. Now, this is important for decision making. Now, how would you use this figure for decision making? Think about it. If you're in a live class, I'd like to hear some answers. How can we get this money? Again, it could be a short-term notes payable. We're going to look for some loans, right, to cover our financing needs. So that balancing figure, when you're given this problem, is your external financing that balances your balance sheet, pro forma balance sheet. Now, cash inflow and outflow can be evaluated by preparing a pro forma statement of cash flows. After analyzing the pro forma statements, the financial manager can take steps to adjust planned operations to achieve short-term financial goals. For example, if projected profits on the pro forma statements are too low, a variety of pricing and of course cutting actions may be initiated. So what they're saying here is that this, in order to avoid this, they can go back to the income statement so they could increase their earnings here. Instead of 6 something, they should be able to find a profit of 8,000, maybe reducing expenses or something. So that helps them in planning. If the projected level of the accounts receivables on the pro forma balance sheet is too high, changes in credit or collection policies may also be called for. So they could also make the decision on the balance sheet if they realize they're only collecting 30% of the sales. They need to shorten that time. So if they collect more money, they will need less financing. And the same thing will go for your business. What is preventing you from getting the money that you need? That's why they say, accounts always tell a story. This is the story it's really telling. Pro forma statements are therefore of great importance in solidifying the firm's financial plans for the coming year. Now, I hope this was beneficial to you. I'll see you in the next session. You can go to your e-learn session now and complete your assignments on depreciation, cash budgeting, and performer statements.